Let's break down the difference between APR and interest rate. It's a critical distinction that can significantly impact your financial decisions, whether you're applying for a loan, credit card, or even checking an investment account. Many people use these terms interchangeably, but they represent fundamentally different aspects of how money is calculated and charged. This video will demystify the concept, providing you with a clear understanding of both, why it matters, and how to interpret them effectively. At its core, an interest rate is the percentage charged on the principal amount. That's the initial sum of money you borrow or invest. Think of it like the cost of borrowing money expressed as a proportion. A higher interest rate means more money is being added to your debt or earned on your investment over time. The interest rate is usually quoted as an annual percentage, making it easy to compare different offers. However, that's where things get complicated because lenders often state their rates as APR, the annual percentage rate. The annual percentage rate, APR, is a much broader measure of the cost of borrowing money. It includes not just the interest rate, but also other fees associated with the loan or credit product. These fees can include origination fees, points, which are upfront fees for securing a mortgage, servicing fees, and even late payment penalties. The APR represents the total cost of borrowing expressed as an annual percentage, making it a far more accurate reflection of your overall financial burden than just the interest rate alone. Let's start with understanding the interest rate in detail. Imagine you borrow $1,000 from a bank at an interest rate of 10% per year. That means after 1 year, you'll owe back the original $1,000 plus $100 in interest, 10% of $1,000. If you repay that loan over 5 years, you'll pay a total of $1,500, the original $1,000 plus $500 in interest, $100 per year x 5 years. The interest rate is a simple calculation based on the principal and the time period. It's a straightforward measure of the cost of borrowing. However, many financial products aren't just about the interest rate. Credit cards, for example, often have an advertised interest rate, but they also charge annual fees, late payment fees, and potentially overlimit fees. These extra charges add to the overall cost of using the card. That's where APR comes into play. Let's look at a credit card example. Your credit card might advertise an interest rate of 18% per year. But if you have an annual fee of $95 and you make a late payment resulting in a $25 fee, the total cost of using that card over a year could be significantly higher than just 18%. The APR takes all these factors into account, the interest rate plus any fees associated with the product. The APR is always higher than the stated interest rate because it includes those additional costs. Now let's talk about how APR is calculated. It's a bit more complex than simply adding up the interest rate and fees. The formula for calculating APR isn't something most people need to calculate manually, but understanding the components helps. The basic formula is APR equals interest rate plus fees / time period * 100. Let's break that down further. The interest rate is the stated interest rate on the loan or credit product. Fees includes all the one-time and recurring fees associated with the product, expressed as a percentage of the principal or balance. Time period is usually expressed in years. For example, let's say you take out a personal loan for $5,000 at an interest rate of 8% per year, and the origination fee is 2% of the loan amount, $100. The annual fee is $50. The repayment term is 3 years, 36 months, using the formula. APR equals 0.08 plus 105,000 plus 55,000 / 3 * 100. APR equals 0.08 plus 0.02 plus 0.01 / 3 * 100. APR equals 0.11 / 3 * 100. APR approximately 3.67%. So, in this scenario, the APR for the loan is approximately 3.67%. Notice that it's significantly lower than the stated interest rate of 8% due to the inclusion of fees and the shorter repayment term. The longer the repayment term, the higher the APR will generally be because the fees are spread out over a longer period. It's crucial to compare APRs when shopping for loans or credit cards. Don't just focus on the interest rate, look at the total cost of borrowing as reflected in the APR. A loan with a slightly lower interest rate might actually have a higher APR if it includes significant fees. Here are some key differences summarized. Interest rate, asterisk, the percentage charged on the principal balance. It's a simple measure of the cost of borrowing. APR, annual percentage rate, the total cost of borrowing, including interest and asterisk, all associated fees expressed as an annual rate. It provides a more comprehensive picture of your financial obligation. Now let's consider some common scenarios where understanding the difference between APR and interest rate is particularly important. 1. Mortgages, asterisk, mortgage rates are almost always quoted as APR. This includes not just the interest rate on the loan, but also things like appraisal fees, origination fees, title insurance, recording costs, and points, if you choose to pay them upfront. Comparing mortgage APRs from different lenders is absolutely essential to finding the best deal. Even a small difference in APR can translate into thousands of dollars saved over the life of the loan. 2. Auto loans, asterisk, similar to mortgages, auto loans are typically presented with an APR. This includes interest charges plus any fees associated with arranging the financing. Again, shop around and compare APRs from multiple lenders, banks, credit unions, and online lenders. 3. Credit cards, asterisk, asterisk, as we've already discussed, credit card interest rates are often advertised, but the APR reflects the total cost of using the card due to fees. Always pay your balance in full each month to avoid paying any interest charges at all. If you do carry a balance, focus on minimizing the APR. This is where comparing cards and negotiating with issuers can make a big difference. 4. Personal loans, asterisk, whether you're consolidating debt or financing a large purchase, personal loan APRs are critical to evaluate. Fees can include origination fees, prepayment penalties, which discourage early repayment, and late payment fees. 5. Investment accounts. While not always explicitly stated as an interest rate in the same way as loans, investment accounts accrue returns based on their performance. The return is often expressed as an annual percentage yield, APY. APY takes into account the interest earned asterisk and any compounding that occurs, meaning interest earned earns more interest. Comparing APYs from different savings accounts and CDs can help you maximize your earnings. Let's address some common misconceptions. All loans with a higher interest rate are automatically better deals. This is incorrect. A loan with a lower interest rate might have a significantly higher APR due to substantial fees. Always focus on the total cost of borrowing as reflected in the APR. APR and interest rate are the same thing. Absolutely not. APR includes fees, while interest rate only represents the cost of borrowing money itself. I don't need to worry about APR if I always pay my balance in full. While this is true for credit cards, understanding APR still helps you assess the overall cost of carrying a balance and potential late payment fees. Resources for further learning. Consumer Financial Protection Bureau, CFPB, asterisk, https www.consumerfinance.gov/. The CFPB provides valuable information and resources on all aspects of personal finance, including loans, credit cards, and mortgages. Investopedia, asterisk, asterisk, https www.investopedia.com/. A reliable online resource for definitions and explanations of financial terms. Search for APR and interest rate to find detailed information. Bankrate, asterisk, asterisk, https www.bankrate.com/bankrate offers tools and calculators to help you compare loan rates and fees. In conclusion, Understanding the difference between APR and interest rate is fundamental to responsible financial management. Don't be swayed solely by the interest rate. Scrutinize the APR to get a true picture of your borrowing costs. By mastering this distinction, you'll be better equipped to make informed decisions about loans, credit cards, and other financial products, ultimately saving you money and helping you achieve your financial goals. Remember to always read the fine print and ask questions if anything is unclear. Your financial future depends on it. To help reinforce what we've covered, let's do a quick recap. The interest rate is the percentage charged on the principal. The APR includes that plus all associated fees expressed as an annual percentage. Always compare APRs when shopping for loans and credit products. And finally, be mindful of compounding. It can significantly impact investment returns. Keep learning, keep questioning, and keep making smart financial choices.